As we kick off 2026, something unusual is unfolding in the commodities space. Gold, silver, and copper are all moving higher in unison. This synchronized rally, blending precious metals with a key industrial one, is a rare alignment that demands a closer look, as it often signals deeper shifts in the global economy. Right now, on January 6th, gold is trading firmly around $4,160 to $4,170 an ounce. This comes after a monumental 68% surge last year, its best performance since the inflationary turmoil of the late 70s. Silver is not far behind, hovering near $78 to $79, having posted an even more explosive gain of over 160%. And then there's copper, the industrial bellwether, holding strong at about $6 a pound. That's over $13,000 per metric ton on the LME, with its own impressive gains north of 45%. So, does this synchronized rise hint at trouble ahead, or open up smart opportunities? Let's pull a few historical parallels for context. We've seen this precious to industrial alignment before. The 1979-1980 period, marked by runaway inflation and severe geopolitical strain, is a classic example. Gold and silver exploded, copper followed suit, and a longer commodity upcycle took hold even after some sharp corrections. A similar, though less dramatic vibe showed up in 2009-2011, driven by massive quantitative easing and a global rebound from the financial crisis. That period led to more consolidation than collapse. Today's environment certainly echoes 1980, with sticky inflation worries, geopolitical tensions, and tight supplies. But, to be fair, history's outcomes have varied, making it crucial to understand the unique drivers at play this time. Fear headlines get the clicks, sure, but a lot of this strength is about solid underlying fundamentals. Let's walk through the key drivers for each metal. Monetary policy's been helpful. Fed rate cuts soften the dollar, which tends to make commodities more appealing. Big U.S. deficits and debt raise debasement worries. And central banks have been buying. We're talking over 1,000 tons of gold last year. Supply's tight. Silver's run multi-year deficits with inventories thinning, and copper's dealing with mine hiccups and years of underinvestment. Demand's got real structure behind it. Solar, EVs, AI data centers, and infrastructure upgrades are all pulling hard on silver and copper. So you get this mix: tech pushing growth on one side, broader uncertainty on the other. What some folks call a dumbbell setup in markets. The market internals strongly back this up. We're seeing open interest, the total number of outstanding contracts, rising in lockstep with prices, which is a classic confirmation of a healthy trend. Furthermore, gold to copper correlations have been flipping positive. This is a crucial indicator, suggesting the rally isn't just speculative froth, but a sign of genuine, broad-to-base demand across both safe haven and industrial metals. Silver, with its unique dual identity, plays both roles: a monetary safe haven like gold, and a critical industrial component like copper. This makes it naturally jumpier and, at times, perfectly positioned for explosive catch-toot moves when it lags behind. Looking toward 2026, what are market players actually saying? Plenty of analysts still lean bullish. Some see silver stretching toward an ambitious $100–200 per ounce, with gold pressing toward $5,000–6,000. They argue this is backed by tight physical markets and historically attractive miner valuations. Of course, the cautious camp points to overbought signals and the chance of significant pullbacks, perhaps silver back to the $50–60 range or gold to around $4,000 if global demand cools. Add in complex links to digital assets like Bitcoin and shifting geopolitical dynamics, and the picture gets murky. Net, the overall sentiment remains constructive, expecting higher average prices, but with very real volatility along the way. With this level of choppiness likely, or perhaps signaling the start of deeper structural resource scarcity, what does this all mean for the broader economy and for your portfolio? Taken together, these powerful underlying trends point toward a future defined by persistent inflation pressure, ongoing fiscal expansion, and an increasingly fragmented world. This environment is fundamentally good for hard commodities, which act as a store of value. Conversely, it's tougher for bonds whose fixed returns are eroded by inflation, and possibly for equities if rising yields make them less attractive. A deep recession isn't flashing red right now. In fact, copper's resilience hints at robust growth pockets in tech and the green energy transition. But rising deficits do add significant late-cycle risk. Therefore, sensible diversification into tangible assets, whether physical metals or quality producers, can make strategic sense, while staying respectful of correction risk. So, what's the bottom line? The potential scenarios are broad. They range from an early breather followed by 10–20% gains in our base case, to a much stronger bull path if inflation proves stubborn. Of course, sharper drawdowns are also possible if global growth unexpectedly slips. In the big picture, with so many variables in play, a rigid forecast is less useful than a flexible mindset. Ultimately, adaptability and a readiness to react will serve investors best as these major market shifts continue to unfold. If this helped, please like and subscribe for weekly macro insights. Thanks for watching.